Does everybody here know who Susie Orman is? Dave
Yes.
Ramsey?
Yes.
Clark Howard?
No.
Everything that Clark Howard, no. He's a local financial pundit that talks about pretty much the same thing as Susie Orman and Dave Ramsey. Do you know what their primary platform is? Get rid of your debt. I'm going to tell you this morning why they're all wrong.
No.
Now, they weren't always all wrong, but today, in today's economy, they're wrong. Anybody who tells you to get rid of your debt, get rid of your mortgage debt primarily, is absolutely wrong. And here's why. Mortgage rates today are the lowest they've been since 1966. They're actually lower than they were in 1966. In 1966, a mortgage rate, you can buy a home mortgage, 30-year home mortgage, for 6.6%. Today, it's 4.5%. And that's even up from a couple of years ago when it was 3.5%. So I'm going to show you why, if you mortgage your house and use that money wisely, you can make money on your mortgage. Let's just look briefly. If you can thole through looking at these numbers, I'll explain to you just the more important things. Let's suppose you have $100,000 worth of equity in your house. I'm going to tell you, or suggest to you, take it all out. Take it as much as you want, as much as you can. Pull all that equity out of your house for as long as you can. So we're going to do $100,000, 30-year term. Current interest rates today are 4.5%. Your payment's going to be a little bit over $500. Over the course of 1 year, you will wind up paying $6,080 in monthly payments. $4,500 or so will be interest. $1,100 of that interest will be deductible on your taxes for your net interest expense of 3.5%. I'm sorry, $3,350, your net interest expense. The net interest rate is 3.35%. That's 3.35% on your mortgage, compared to 6.5% in 1966, compared to 16% in 1981. Now we're going to take that $100,000 and we're going to invest it in stock. How do you buy stock, right? Buy low, sell high. Well, that fluctuates on a day-to-day basis, and you think if you're thinking about it every day, you're going to drive yourself insane. But over a long period of time, the stock market goes up. In 1985, the Dow Jones Industrial Average, which is a composite of 30 stocks of U.S. companies, was $1,300. $1,300 would buy you a portfolio of that industrial average. Today, it's 16,000. So in that 30 years, that Dow Jones Industrial Average value has gone up 10 times, or over 10 times. Here's what the Dow Jones has done. In the last 10 years. So in 2004, the Dow Jones was about 10,500. This 2008, it reached about 13,500. We all know what happened in 2009. It's back up to where it started almost in 2013, and here's where we are today, 16,500. 10-year growth, 58.82%. So roughly 6% growth a year, including this. But if you looked at the growth from 1985, it's over 1,000% growth. It's actually like 1,300% growth. Well, you're really going to be concerned about something like this. This is pretty critical. It's happened 3 times in the last 30 years. Once in 2008, it dropped 43%. That's the biggest drop since the Depression. In March of 2002, 3 months following or 6 months following 9/11, it dropped 29%, and in October 1997, it dropped 33%. But as you can see, over the long term, 10 years, stock market's up 60%. So what we're going to do, we're going to take our $100,000 that we borrowed, we're going to buy a portfolio of stock. And our stock, and these are 7 of the 30 stocks randomly picked out of the Dow Jones Industrial Average. So, starting price, 1 year estimate, this is just the future, the growth of the stock. But what we'll see ultimately is at the end of 1 year, our stock portfolio, we started at $89,000 worth of stock. I wanted to keep 10% of our money in cash in case of an emergency. We do need to make our monthly payments. So we have this cash to make our monthly payment. At the end of the year, our stock portfolio has grown almost 12%. So we've earned 12%. We're going to have to pay taxes on some of that. So ultimately, we'll earn just under 10% on our stock portfolio. And we're paying 3.5% on our mortgage. So we're earning almost 7%, 6.5% based on leveraging our mortgage. And that's what we have here. In summary, we start out with our investment. Of $90,000. We've got $70,000 worth of growth in our portfolio, and that's just based on the average of the 10 years. So our portfolio value is, in 2024, 10 years from now, is $157,000. Our mortgage will amortize down to $80,000 in 10 years. So the value of leveraging our home, pulling out that $100,000 and investing it in stock, is $77,000. That's what we can make by following this plan. So finally, what I'll say to Dave Ramsey and Susie Orman, Clark Howard, is I'm going to mortgage my house. And I'm going to pull out all the money I can, and I'm going to invest it because I can do it more wisely when interest rates are at 4% and less. Thank you.